Bitcoin OGs unload $118 million as the Fed kills the easy money illusion. When the central bank tightens its voice, the old hands move first. They do not panic. They recognize the weather before the crowd even looks up. And that is the quiet terror in this story. Not that Bitcoin fell, but that those who held it longest felt the shift before everyone else did. We are watching a familiar pattern unfold. The market dreams of lower rates, cheaper money, and endless relief. Then the Fed speaks with just enough severity to remind everyone that liquidity is not a birthright, it is permission. And when permission weakens, risk assets begin to breathe differently. You see it now, don't you? The selling did not begin with fear. It began with calculation. Long-term Bitcoin holders, the so-called OGs, those early believers who have survived every cycle of disbelief, started pressing supply into the market. After the Federal Reserve signaled that rate cuts may arrive more slowly than traders wanted. More than 1650, Bitcoin changed hands in one sweep of conviction and caution, worth over $117 million. One whale added another slice to an already massive exit. Another early adopter emptied out a full 1,000 coins. That is not random behavior. That is judgment, and judgment always arrives before consensus. Bitcoin slipped near $70,600 as if the market itself had lost a little confidence in its own narrative. But look deeper than price for a moment. The larger wound was not in Bitcoin alone. Ether weakened, XRP weakened, Solana weakened, Doge weakened. The entire speculative layer felt the same pressure because all risk assets are tethered to one invisible chain, cheap capital. Break that chain, even slightly, and suddenly, every grand projection becomes a thinner story. The Fed left rates unchanged at 3.55% to 3.75%, which by itself would have sounded neutral to anyone still pretending language matters less than liquid. But language does matter, especially when central bankers speak in gradients rather than absolute. The real message was inside the dot plot, that sterile little map of expectations where policymakers quietly sketch their future intentions, while markets pretend they are surprised every single time. The median projection pointed to only one rate cut this year, not two or three, one. That is how optimism dies in modern finance. Not through catastrophe, but through revision. A month ago, traders were leaning into a softer path, pricing multiple cuts, as if monetary gravity had already loosened its grip on reality. Now those bets are being repriced with all the mercy of arithmetic. Around an 80% probability of just one cut remains where once there was far more hope for easing. This is what happens when expectations outrun policy. Disappointment arrives dressed as restraint, and restraint is poison to speculative appetite. Let's pause there for a second. What really moves markets? Is it policy itself, or the gap between what people expected and what they were given? That gap is where volatility led. The Fed's tone was hawkish not because it raised rates again, but because it refused to confirm the fantasy that easing would come quickly enough to rescue risk sentiment from every wobble in growth data, or labor weakness, or political noise swirling around inflation. Forecasts once again emboldened. Why energy costs rising in the background like an old debt, never fully paid off. Inflation has memory too. It does not vanish because traders want relief on schedule. It lingers, waits, reasserts itself through wages here, fuel there, supply shocks. Everywhere, people insist should have been temporary months ago, and yet never were temporary in any meaningful sense at all. So when investors hear higher for longer, they hear something much larger than interest rates. They hear duration. They hear opportunity cost. They hear capital refusing to be cheap. They hear leverage becoming less forgiving. They hear time itself demanding payment. And if you understand human action, you know why this matters so much. People do not buy speculative assets only because they believe prices will rise. They buy because they believe tomorrow will be financed by easier conditions than today. Remove that belief and behavior changes immediately. The future becomes more expensive. The impulse to reach for yield fades. The appetite for risk shrinks. The hand hesitates before clicking sell, unless it belongs to someone who has already seen this movie enough times to know how it ends during tightening cycles. This is why OGA selling matters more than casual liquidation from weak hands. Weak hands sell from fear. OGs sell from memory. Memory carries weight in markets because experience teaches patience where slogans fail. An early holder does not need a lecture about cycles. He has lived them. He has seen euphoria become denial, and denial become capitulation so many times that he can feel policy drift in his bones before analysts finish updating their models. That makes this moment psychologically important, even if price action remains orderly on the surface, because surfaces lie. Liquidity tells the truth underneath them. When long-term holders distribute into strength or into uncertainty around macro policy, they are expressing one of two things. Either they believe upside has become limited relative to risk, or they believe cash now offers better optionality than waiting for additional appreciation under worse conditions later on. Both interpretations point toward caution. Both reveal a change in preference. Both say something simple and brutal. The marginal conviction has started to soften at the edges. And once conviction softens among those closest to history, everyone else feels it as atmosphere first and price later. Why did these sellers move now? Because central banks do not merely set borrowing costs. They set emotional probabilities across entire asset classes. Everywhere, capital hunts for return under uncertainty and hopes. Mathematics can protect it from regret, though it never really does when conditions shift beneath assumptions faster. And models can adapt. There is another layer here we should not ignore. Bitcoin's relationship with macro liquidity has matured into something no serious observer can dismiss anymore, even if some still prefer myths about complete isolation from traditional finance, because narrative purity feels safer than admitting correlation exists whenever credit gets tighter and speculative energy gets drained from every corner at once. Bitcoin may be decentralized money by design. But price discovery still happens inside a world where dollars matter, where real yields matter, where leverage matters, where liquidity determines whether buyers feel brave enough to chase. We do ourselves no favors pretending. Otherwise, this does not weaken Bitcoin. It clarifies Bitcoin a sound asset lie. Being inside an unsound system will still feel pressure when that system withdraws fuel. That is not failure. That is exposure, and exposure always reveals. This week's reaction exposed who was buying hope rather than truth. Some traders heard no immediate cuts and rushed towards safety. Others heard one cut instead of several and recognized reduced oxygen for risk-on positioning. Still others saw an opportunity because Bitcoin has always punished impatience as efficiently as it rewards conviction. But here lies the paradox. The same macro tightening that hurts short-term speculators can strengthen Bitcoin's long-term case. Why? Because every reminder that fiat liquidity comes with strings attached pushes serious observers back towards scarcity, back towards settlement outside discretionary promises, back toward assets whose supply cannot be voted upward when politics get uncomfortable, back toward money that does not require TRE. Austin Committee, moods or inflation forecasts revised after each surprise, when central banks signal caution around inflation while energy prices rise. Again, like smoke returning through an open window, you can almost feel capital reconsidering what kind of store survives. Prolonged uncertainty we shall. I will also talk about timing, not just price level. Timing and OGA selling after a hawkish Fed tells us something important about marginal behavior among experienced holders. They are willing to exchange some upside participation for certainty now, rather than wait inside a regime where borrowing costs stay sticky and enthusiasm becomes more fragile by the day. This isn't necessarily bearish forever. It isn't even necessarily bearish broadly, but it is undeniably a warning about sentiment under tightening conditions. Here's another question worth holding quietly. If those who knew Bitcoin earliest begin rimming when policy turns less friendly, What does that say about how much air remains under speculative valuations across everything else? In markets, we often confuse resilience with immunity. They are not cousins. They are opposites wearing similar clothing. Bitcoin can remain structurally strong while still reacting sharply to monetary tightening. That distinction matters because too many people want absolute narratives. Either Bitcoin decouples instantly from macro conditions, or it must be dismissed whenever volatility returns, as though truth were required to perform perfectly on command before earning respect again. Reality is less theatrical and far more instructive. Bitcoin sits at a strange intersection. Part monetary rebellion, part global collateral story, part savings technology, P-safe. Art risk asset during transitional phases of adoption. So yes, when liquidity tightens, the market flinches, but flinching is not collapse, it is sensitivity, and sensitivity means transmission works. Look at what happened across altcoins as well. Ether weakened alongside Bitcoin, XRP softened to Solana. Slipped. Doge lost ground with no drama whatsoever, except the usual silent proof that meme speculation depends heavily on abundant confidence in abundance. And confidence depends heavily on easy money, more often than believers care to admit aloud. This matters because altcoins live closer to narrative heat than monetary conviction. They burn brighter when capital chases fantasy and fade faster when investors remember. Balance sheets exist every cycle. Rip. As this lesson again, when liquidity expands, speculation dresses itself up as innovation. When liquidity contracts, innovation gets separated from that. Either very quickly. That separation embarrasses many projects, but clarifies everything for us watching carefully. Bitcoin endures such moments differently. Not because price never falls, but because its scarcity remains unchanged while surrounding narratives strain under costlier capital. Scarcity does not need marketing, it only needs time, and time always sides with what cannot be diluted. We should also notice how quickly expectations reprice once institutions speak plainly. A month ago, 2 or 3 rate cuts sounded plausible enough for markets hungry for relief. Now one cut looks increasingly like consensus. Nothing physical changed overnight, except belief, and belief drives allocation more powerfully than most people admit until after losses forks. Honesty. This is why Fed watching becomes almost ritualistic during these periods, not because policymakers are omnipotent, but because their words alter. At discount rates across portfolios built on borrowed confidence, a slight shift in tone can move billions, not due to magic, due to structure. When cost of capital rises relative to expectation, every asset priced off future optimism must adjust downward somewhere eventually. Some adjustments happen slow, like others happen violently, but all of them happen. Those who understand this do not worship volatility. They respect causality. Another layer deserves that attention. Energy costs. Rising energy does more than pressure headline inflation. It reminds us that physical reality still governs abstract financial dreams. You cannot vote away fuel costs. You cannot narrative print your way out of entropy. You cannot ask households or corporations or markets alike pretend inputs are stable while transportation and production become dearer. Energy inflation spreads like weather through every sector, eventually reaching consumer prices, wage demands, margins, policy debates, everything. So when analysts say higher for longer, what they really mean is this: time remains expensive because reality refuses obedience, and expensive time changes human action. Borrowers borrow less aggressively. Speculators rotate out of leverage funds, rebalance toward duration-conscious positions. Retail participants hesitate longer before chasing momentum. Treasuries regain some allure relative to volatile assets, depending on yields, inflation expectations, growth fears, all colliding in one uneasy arithmetic equation. Meanwhile, Bitcoin sits there untouched at protocol level, yet continually priced by humans whose preferences shift under stress. That tension between unchanging issuance and changing demand dynamics lies at the heart of every serious discussion about crypto valuation. We don't need mythology. Here we need clarity. Clear it. Why says this? If rate cut hopes dim further while inflation proves sticky, then liquid capital will continue discriminating harder among assets. Clarifying. Further, discrimination usually punishes excess. First, excess leverage, excess speculation, excess narrative confidence, excess dependence on easy commodity. Once the market strips these things away without apology still, do we mistake correction for rejection? No matter how loudly frightened traders speak after each red candle, systems built on scarcity often survive, precisely because they do not depend on coup. Einstein applause. Bitcoin does something unusual within modern finance. It forces participants into honesty about time preference. If you need immediate validation, you will hate its volatility. If you understand long horizons, you may welcome exactly what others fear. Every dip test, whether conviction was philosophical or merely rented by momentum. And right now, momentum has clearly thinned. That thinning explains why veteran holders sold millions in Bitcoin after hearing what amounted to a colder version of guidance from Powell's camp. Not panic again. Judgment, there's dignity there, actually better. An informed exit than blind loyalty dressed up as virtue. Yet let's be careful with conclusions. One whale trimming supply after macro disappointment, though. As not define an entire regime change alone. Markets are too complex for such lazy certainty, but patterns matter when repeated by actors with long memories. If multiple early holders reduce exposure during tightening rhetoric, then we should interpret this as distribution into uncertainty rather than R. Random noise distribution tells us something essential. Somebody believes current price already reflects enough optimism, perhaps even too much relative optimism given shrinking odds of rapid easing. When seasoned holders decide cash today may be preferable, optionality tomorrow, while carrying less exposure. Sure, through slower cuts, stronger dollar dynamics, sticky inflation, well, then we are no longer discussing headlines alone. We're discussing shifting incentives embedded inside human action itself. This is praxeology made visible on a chart. People act according to expected satisfaction under scarce means. Uncertain futures, changing constraints here. Those constraints come from monetary authority signaling fewer gifts ahead. Therefore behavior adjusts. See Powell merciless true. If you listen closely beneath all technical jargon, all futures probabilities, all dot plot theatrics, you hear one ancient rhythm, say. Scarcity returning, desire recalibrating, risk becoming choosier, liquidity losing some charm, and beneath all that, truth regaining its leverage maybe. That is why moments like this feel heavier than ordinary pullbacks, because they remind us how dependent modern valuations remain on collective belief. Inaccommodative conditions remove certainty, and prices stop floating quite so effortlessly. In quieter terms, the market was borrowing light from tall. The Fed dimmed it. So where does Bitcoin stand inside this scene? Exactly where scarcity keeps standing, unmoved by committees, unchanged by speeches, yet revalued constantly by human beings trying to decide whether fast money deserves trust over hard money. That decision never ends entirely. Each cycle revisits it. Each tightening phase sharpens it. Each disappointment expectation makes sounder alternatives easier to see, and maybe that's why these OJ sales matter so much beyond their dollar value. They act like tremor. Ahead of larger emotional weather, not prophecy, just evidence. We end here with an image worth keeping close. A room full of traders staring at projections drawn in pencil, while outside, time keeps charging interest. What survives when cheap hope disappears? What remains valuable when permission becomes scarce? You already know which answer keeps returning. If you're willing to sit with it long enough,